Hey everyone, welcome back to Corporate Decoder. Today PED just filed a second amendment to their credit agreement and I am seeing one red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is tweaking how it calculates its earnings and the timing of when it needs to report its oil and gas reserves, which could signal upcoming financial pressures. Alright, let's dive into what PEDEVCO Corp has just reported. This filing is an update to a previous agreement they have for borrowing money, kind of like a loan contract. They've made some changes to it, and these changes are worth looking at because they tell us something about how the company is managing its finances and its operations. Specifically, PEDEVCO has entered into a second amendment to its credit agreement. Think of this as tweaking the rules of a big loan. This agreement is with Citibank as the main agent, and it involves several lenders. The important date here is May 5th, 2026, which is when this amendment officially took effect. Now, let's get to the juicy details. The first big change is to how they calculate something called EBITDAX. EBITDAX is a financial metric that helps companies measure their operating performance before accounting for interest, taxes, depreciation, and amortization, and importantly for this industry, exploration expenses. They are updating the limits on what costs they can add back to this calculation when they buy or sell oil and gas properties. The cap is now the greater of $6 million or 5% of their current borrowing base, which is $120 million. This update also allows them to add back an estimated EBITDAX from October 2025 for companies they acquired that month from Juniper Capital Advisors. This is a significant adjustment to how they report their earnings, and it's a way for them to potentially show a stronger operating performance, especially when they are in the process of acquiring or selling assets. Companies often do this to meet the requirements of their loan agreements more easily. Next, they're changing the definition of a test period. This is the time frame over which financial performance is measured for loan covenants. Starting with the period ending the 31st of December 2025, they'll begin annualizing their EBITDAX. This means they will gradually move towards a full trailing 12 months calculation by the 30th of September 2026. This change suggests they are likely facing short-term performance challenges and are adjusting the measurement period to give themselves more breathing room and avoid breaching any loan terms. It's like giving themselves more time to hit a target. Then they are rescheduling when they will reevaluate their borrowing base. This is the amount of money they can borrow based on their assets, primarily their oil and gas reserves. The next review is now scheduled for around the 1st of July 2026, and after that it will happen twice a year in April and October. This delay in re-evaluating the borrowing base might indicate that they anticipate their asset value could decrease, and they want to postpone that assessment. Finally, they are also adjusting the schedule for when they need to deliver their reserve reports. These reports are crucial for determining the value of their oil and gas assets. The next report is due around the 1st of June 2026, with future reports due in March and September. Similar to the borrowing base redetermination, this adjustment could suggest uncertainty about the current value of their reserves. This entire amendment is filed as Exhibit 10.3 to this report, and it is a pretty detailed document laying out all these changes. Because these changes directly affect their financial obligations and borrowing capacity, this information is also covered under Item 2.03 of the filing, which deals with new financial obligations. And as is standard for these reports, we have a section detailing all the exhibits, which includes the original credit agreement and these amendments. Looking at this filing, my main takeaway is that PEDEVCO is proactively making adjustments to its credit agreement. The changes to EBITDAX calculations, the test periods, and the reserve report schedules all seem designed to provide the company with more flexibility and potentially avoid breaching covenants if its performance falters. We've seen similar moves from companies like Bed Bath & Beyond and Tupperware, where adjustments were made to loan terms as financial pressures mounted. While these amendments aren't a direct crisis signal, they do suggest the company is anticipating challenges in its operational or financial performance in the near future. Particularly concerning the valuation of its oil and gas assets, the fact that they are bringing in an estimated EBITDAX from a prior acquisition from Juniper Capital Advisors LP is particularly interesting given Juniper is also listed as a top institutional holder. This could be a strategy to bolster their reported earnings in the short term. My biggest concern is that these changes might be a sign of underlying stress in their business model, rather than just routine adjustments. What I am actually looking for is how these new calculations and schedules will play out in the coming quarters, and if they will be enough to navigate potential headwinds in the energy market. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like, comment, subscribe, and join our Discord community.